Joining us right now to talk more about what's happening in the markets is Oksana Aronov. She is fixed income strategist at JP Asset Management. Also, Peter Boockvar, who's chief investment officer at Bleakley Advisory Group. He's also a CNBC contributor. And Peter, just looking at the markets, going back a year, we're kind of in the same position that we've been through this whole time.
Chopping around, digesting the rate hikes from the legacy ones, in addition to the balance sheet shrinkage on top of the tariffs, and being in the 10th or 11th year of an expansion, a slowdown in hiring, in part due to the lack of supply of labor, all leading to this slowdown in China also. So I think earnings now sort of flatlining and the market's digesting a multiple that was inflated and we need to sort of grow into. Well,
that's what I wonder. Have we grown into it at this point? We've gone nowhere for a year. We're looking at earnings expectations that are beating, granted, lowered expectations coming in through this. Is this a point where you think the market could finally push back up and push through 3,000 or not?
You need the earnings acceleration. We're trading at 18 times earnings, so that doesn't leave you much room for error. So you need, what's happening now with earnings is margins are now contracting. So revenue growth is still okay. Nominal GDP growth around the world is about 3%. Revenue growth in the S&P is actually a little above that, but margins are now contracting. A lot of that is good in a sense because it's because of higher labor costs, so it's good for employees, but it's impacting employer profit margins.
Oksana, I guess the other side of that is, okay, look at what you're getting in treasuries right now. Yield is next to nothing, and corporates are kind of mimicking that too.
Absolutely. In fixed income across the board, the story is the markets are extraordinarily rich, extraordinarily highly correlated, and liquidity is tenuous at best. When you look at the richness, even in some of the extended sectors like lower rated credit, currently high yield spreads are implying about a 7% recession probability over the next 12 months, whereas, the consensus is at about 25 to 30%. So the last time this gap existed was in 2008. And kind of across the board, spreads are pushing towards the tightest end of their historical range. And that means everything is acting like treasuries because everything is sitting right on top of treasuries, hence the high correlation. And finally, on the liquidity side, you really have no liquidity. We're seeing signs of this in the repo market, frankly, right, where banks are really limited in terms of how much balance sheet they can lend, and the ownership of the market has changed dramatically. It's shifted really a lot to the mutual funds and the ETFs, not really a great liquidity landscape.
I mean, that sounds crazy. You think of where we are, what central banks are doing. We should be awash in liquidity, and I think we probably are. If you look at places like the private equity or the public equity markets where you have all these big valuations that have pushed things up. I just feel like there's money everywhere and it's creating bubbles.
Liquidity has really shifted to the buy side, right, from the sell side. But the buy side decision-making process is so different. It involves investment committees and it involves having to sell something, to buy something. And on the Fed, and the fact that the Fed has kind of done this about phase last year and is now in easing mode, right? And this should tell you just how close to that zero bound we are. You would think that in this environment of the Fed easing again, you would see, the ag outperforming. And it has locked in really great gains so far this year. But in September, the aggregate was down, generating negative returns. And so far in October, it is as well. Who would have thought that in an environment where the Fed continues to ease? So that tells you that there's really an extremely limited opportunity set in these sort of traditional fixed income pockets.
Peter, you don't think the Fed is going to ease in this meeting?
I think that they'll end up following what the market is saying. The market is pricing in that. But if you get some détente with China and you get a Brexit deal resolved, I don't see why they feel any pressure to cut. Not much has changed in terms of the data from the last meeting to this meeting. And in fact, you've had some global developments sort of clearing up. So I don't see the need. In addition to, I don't see the benefit. You're talking about cutting rates from an already low rate. You look at the housing market, the bond market, the long end has already cut 100 basis points for anybody looking to buy a house. The auto market is not going to be stimulated by a 25 basis point cut because the average price of a car is now 60% of the median income in this country. So you're not going to stimulate auto sales. Corporate leverage is extraordinarily high, so companies are not necessarily going to use that 25 basis point cut and go out and borrow more. So there's not enough analysis, in my opinion, on the part of the Fed to see what are they actually stimulating when rates are already so low.
Peter, Oksana, I want to thank you both for being here today. Good to see you.
Thanks.